Hello, welcome to the Economic View. I'm joined as always by Evan Lucas, our market strategist. Hi, Evan.
Hello, Tony. How are you?
Yeah, very good. Now, yesterday, I knew what the result was going to be yesterday on Melbourne Cup Day.
Yes, so did I.
And so did you.
Yeah, and nothing changed there. I wish I knew the result of what actually would happen at the Cup.
Yeah, we're not talking about the horse race.
Unfortunately not. Everything was the same, and that's what needs to be clearly put out there, was if you look at what came out of Martin Place, clearly no rate movements. The interesting movement I saw yesterday was actually in the interbank market, which is the swaps market for the probability of a rate movement up or down through to November. That's as far out as the data that we have at the moment. It moved lower still. So what it's saying is the probability of a rate hike is now moving to, by November next year, the probability, according to the interbank market, is about 65%. If you had asked me that question to what it was in September, it was 100. So just to give you an example of how far away the market has fallen off the probability of seeing a rate rise next year, it's 40-odd%.
So we've had 15 straight months of no change. That's going to continue for the foreseeable future.
If you look at it from that perspective, we are talking about the possibility of adding another 12 months on top of the 15 we've had so far. So that's what the market's telling us. Then look at the statement itself. A lot of people are really highlighting the fact that there was not a huge amount of change from the October to November statement, but there are lots of signs that they are probably neutral towards the dovish end rather than neutral towards the hawkish end. I know we've got a more hawkish member than Stevens with Philip Lowe, but in saying that, he's clearly pointing out that there is just not the scope to do it. And the other thing that's coming out over the last sort of 2 to 3 weeks, there was a really good report from Macquarie actually today around the reweighting that's about to happen in CPI. So in December, the ABS is actually slightly changing. And I know this is a little bit dull, but apologies. They're going to change the way that they actually weight CPI and their inflation. What they're going to do is what they call substantiation, which is basically the idea that people are buying less, more expensive things and vice versa on the other side. They're trying to reweight that. They believe it's going to cost about 0.25%. So 25 basis points in the inflation figure. Doesn't sound like a huge amount, but when the inflation figure is sitting at 1.8% for core inflation, you take out a quarter and their target band is 2 to 3% to maintain it, it's a long way away. It's a long way away. So again, all of that filters back into it, which is why Friday, the statement of monetary policy is so key. As far as I can read, most brokers, barring probably the most hawkish, which are ANZ, Westpac, Goldman Sachs, are all believing that inflation outlook will be downgraded, and even some of them are forecasting that GDP outlook will be downgraded. So that would be a negative for the currency. It's a positive for the equity market. I'm sure we'll talk about that, but that's what we took out of yesterday. So it's a lot of data to digest. I understand that, but as we said, we both know the outcome, and I expected exactly what happened in the statement to be put through to the market, which is RBA's out, possibility of downgrades to GDP and inflation puts pressure onto the Aussie.
Yeah, it hasn't changed that much, but what has changed also yesterday was that the ASX 200 finally got back above 6,000. It's been promising to do that for so long. It's finally got there. So interesting dynamics, but a large part of that relates to resources, commodities, and what's happening in terms of demand for our raw materials.
Yeah, so last week we talked about the chart that showed how much of a relationship Australia has with China. So we are very much beholden on China's net exports of our GDP. So if you have a look, China is a country mile ahead of our nearest export partner, which is now actually India. Korea and Japan sort of touching each other, then the US. But I'm talking there is a gigantic gap between China and India in terms of, and that gets bound to those bulks. So their trade balance now, particularly at the back end of this year, is looking like it'll slow down. We know that they told us that leading up to the People's National Congress. So their imports figures is actually having its best year since 2012, particularly bulks, which is why I've been really bullish on commodities and why I've been quite bullish on commodity stocks and our market as a whole. We are also a proxy for a China play if you do want to get involved. So we may see the back end of this year being a little bit weaker, but I am more positive of it in 2018. And this is the bright spot, is that yes, domestically things are slow, but internationally things are really ramping up. We know about global growth and we are exposed to it with China. And you've got to keep that as probably your mantra in the back of your head, is that if we are to hold above 6,000 points, I personally don't think we will do it in November. Do think we'll do it in December, like go through it and hold. I think we might come off a little bit at the current because we've got dividends coming out of the banks and a few other flat things. But if you look at it from a growth perspective, China is the story, and 2018 is probably where you're going to see it. And that gets back to your point. Commodities do look like they'll have another pickup next year. China's growth story has to remain to 2020. And therefore, any dips in the ASX are likely to show that if it comes on the growth side of our market, cyclical plays like energy, materials handling, mining services, blah, 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 that they probably will be okay next year. And that's where the excitement is coming. So there is a flip side to all that inflation talk. There is some growth side coming as well.
Yeah, there's certainly some positive signs out there in terms of, the China story and what that means for us. Not that long ago we were talking about, doom and gloom into the mining boom, but not saying that there's another mining boom, but it's
half
certainly picking up.
Yeah, half a renaissance they're sort of talking about is that, yes, you're right, it won't be a 2012-13 peak, but there is a second wave coming, which is a positive. Again, depending on your time frame, and this is what we're talking about here, what is your time frame? I talk in 3 years at the moment because I don't think you can really go past that. Those that talk in decade and are looking to sort of like what 2027 looks like, even 2025, it will be different. Clearly, 2020 is a bit of a cut-off point between the last decade, the 10s, and what the 20s are going to look like. That will be a different story, and I'm sure you will see that starting to filter out, particularly at the back end of next calendar year, start of 2019. You really will start to hear what China is, what the US is, because this is what we've got to also remember, is that the US story is still very positive. Europe is finally showing positive green shoot signs of growth. So we are connected to all this. And that's why I said our exports are what to watch. They are the bright spot and possibly the reason that we actually get some form of backstopping to any domestic negative news that we get.
Oh, thanks, Evan. We'll leave it there today.
Thanks, Tony.
Thanks for joining us on The Economic View.